Good afternoon, everyone, and welcome to TradeStation for our webinar this afternoon, our webcast series of educational seminars. I want to include or welcome today our presenter, Mr. Joe Burgoyne, who is the Director of Education for the OIC. That's the Options Industry Council. And the mission there is to increase the awareness, the knowledge, and the responsible use of exchange-listed equity options among a global audience of investors, including individuals, financial advisors, and institutional managers. The OIC is an industry resource funded and managed by the Options Clearing Corporation, the world's largest equity derivatives clearing organization, to provide education to investors about the benefits and the risks of using exchange-listed options to gain market exposure. Our presentation today is for educational purposes only. All the symbols and all the trading ideas that we discuss are for demonstration purposes. They are not recommendations. This presentation is not an offer or a solicitation of any kind in any jurisdiction where a TradeStation affiliate is not authorized to do business. Remember that active trading may not be suitable for you. It does carry a high degree of risk. Options trading does carry a higher degree of risk, may not be suitable for all traders. I've posted in the chat panel a couple of pieces of disclosure information that you can click on and open at your convenience that covers the characteristics and the risks of standardized options and other asset classes that we trade here at TradeStation. Sorry about the static. It actually sounds pretty good to me, but that's just, that could be a temporary condition. Joe will be with us in a moment. So I want to bring Joe Burgoyne of the Options Industry Council to our presentation today and welcome him.
Maybe I'll take it from there, Don. How's that sound? Hello, everybody. Don, thanks so much for passing the baton there. And again, everybody, thanks for joining us. Goodness knows, this is a marketplace for rolling options, that's for sure. So again, thanks for taking the time to join us. We'll over the next half hour or so we'll go through actually some call rolls, 4 call rolls, 4 put rolls, and tell you how we go about it, from our perspective here at OIC. As I think everybody knows, and when we do these webinars, it's we have attendees with varying levels of expertise. So I hope that we can offer a little something for everybody out there today. As we know, options involve risk and are not for everybody, but that's where Don and the great team at TradeStation, along with their platform, come in to assist you with some of the intricacies of the business. Today we'll talk about initial considerations, starting with basically a call and a put position, and then we'll talk about rolling the calls and rolling the puts. And before I get into that, maybe I just give you a little update. I mean, obviously we've got some volatile markets in the first 2 months of the year. Just a little update on the volume that's going on in the marketplace, on the listed options side. So I think the remarkable thing over the last couple of years was that despite historically low volatility, as everybody complained about, and we had that for a better part of 2 to 3 years, option volume maintained its levels in the 16.5 to 17 million contracts a day levels. And I think really that was the story looking back. Now, since the end of January, obviously the marketplace has taken on, volatility levels that are a little more consistent with historical standards. So in the month of January, we went from, as I mentioned, that daily volume level had been in the 16.5 million contract range. We got to just about 23 million contracts per day in the month of January. And of course, we just closed out February and average daily volume in February was north of 25 million contracts. So, option volume, you throw a little volatility and in some cases a lot of volatility into the marketplace. And, these versatile products that, have helped people generate income in this low interest rate environment, and of course are always a staple for risk management, seem to be a go-to for more and more investors. So, I just wanted to update you with that before we get going. So let's start with our initial considerations and really some ideas, I guess, on position management before we get started. Whatever your approach, and I was fortunate enough to trade the options market for 23 years in Philadelphia as an options trader. My approach would be I'd start with the charts and then go to the implied volatility charts. That's how I, went about my research with the different issues that I trade. Your approach, I'd say for all of us listening in, we all probably have a different approach, whether it's technical analysis, whether it's really intricate implied volatility analysis, whether it's fundamental analysis, on the companies that you're trading. Everybody tends to have a different approach. The important thing is that you do your homework. And then on top of that, I think this is frankly at least as important, and I think frankly more important. If you're in the game, you got to have a plan. And the key to longevity is executing that plan with flexibility for sure. But if you have a plan, stick to it. And going backwards a little bit, you frankly can't have a plan unless you know yourself as an investor. Are you a short-term trader? Are you a mid-term or long-term investor? But on top of that time frame component, what's your risk tolerance? And you got to know that risk tolerance. Then you can kind of decide on
Hello, everyone.
what that plan's going to be given that risk tolerance. So I'm guessing that most everybody on the webinar today knows that, but important to have that discipline once you establish that plan. I mentioned flexibility. I think that's Don, on the right-hand corner of the slide. He's got lots of flexibility, as do the tools at TradeStation. So that's one of the great things about options. They are incredibly dynamic. That's why, to me, the options market is so much fun. That dynamic aspect of implied volatility is really what sets it apart and makes it such a flexible financial tool. So, of course, before we open our position, we want to be sure that you've got all clearances at the different levels required with TradeStation. And then, of course, I'm not a Ouija board guy, but obviously, if we're going to initiate option positions or any investment position for that matter, we've got to have an opinion. And I told you my approach. I get my opinions. I start with the charts because I believe charts are the universal supply and demand of knowledge of the underlying. Since I'm an options guy, then I go to the implied volatility charts. And if three choices. The beautiful thing about the markets. You can go up, you can get down, you can go sideways. And as it relates to option strategies, I think it's a good idea not to try to, become fairly adept and expert at, lots of the option strategies that are out there, but get darn comfortable with, one, two, or three bullish option strategies. The same with bearish option strategies. And then, of course, there are times where maybe you think, the markets are just going to kind of go sideways, or, you want to take some money out of the markets with credit spreads. Be comfortable with a couple types of them. So maybe in all, you got a half dozen or so option studies that you really want to become, good at, and certainly the tools at TradeStation can help you with that. And around that, you just, whether your forecast is bullish, bearish, or neutral, you can select a particular strategy. And of course, after we establish, different things to consider. Is my forecast correct? Did I choose the right strategy? Got to tell you, 23 years on the floor down in Philly, and the thing that made, of course, the goal is to make money, but the thing that made me frankly most satisfied is when I was dead wrong and wouldn't lose a lot of money. I knew I'd been flexible. I knew that maybe, even though I was dead wrong, I had chosen a strategy that wasn't going to kill me. I tend to be risk averse, so that would help that. But being quick, being flexible, I think that's important in the option space and the investment space. But that speaks a little bit to how often you're going to be using the option product. Making adjustments, that's obviously what we're going to talk about. Taking profits, cutting losses, what's your time frame, understanding your break-even points. I'll go through the strategies, and then at the end, tell us, everybody, exactly how we define those new break-even points. So let's talk about rolling calls. Here's our initial position. We've got XYZ, our favorite stock at OIC. We're bullish, darn bullish. Stock's currently trading at $50. Initial position, as I say, darn bullish. We're looking in 2 months for the stock to go up 20% from 50 to 60. And that should happen, by the June time frame. So we initiate a position to buy 10 of the June 50 calls at $3. For those of you who may not be too familiar with options, each contract corresponds to 100 shares of the underlying. On the call side, it's the right to buy each contract, and we have 10 of them. Each contract corresponds to the right to buy 100 shares of XYZ at 50. So times 10, we've got the right to buy 1,000 shares of XYZ at 50. And for that, we're going to pay $3 for each contract. Each contract corresponds to 100 shares of the underlying. So that's 3 times 100 for each contract. Each contract corresponds to $300 times 10. We've got a $3,000 investment. And here's how it looks. Break-even point. Let's go to that. We take the strike, the 50 strike plus the premium paid, $3. Add those two, gives us our break-even point. So at expiration, and we've got 60 days, if the stock is not north of 53, we're going to be in the hole. But as the chart to your right suggests, and one of the great things about certain option strategies, your maximum loss, when you go into these things. And you can see bottom right-hand side in red, no matter how far that stock craters, if you happen to have been, completely incorrect with your forecast, the most you can lose is that $3,000. Certainly a lot of money, but at least going in what your maximum downside is. To the upside, as the blue line shows, unlimited profit potential to the upside. So that's our initial position. Let's take a look at one scenario. So playing with house money. I actually love to do this on the trading floor. Still do. Stocks had a good run. If we go from 50 to 56 and we've still got 3 weeks left to expiration, not a bad run. Clearly, we've got solid appreciation in those 10 calls. Still bullish, okay, but with 3 weeks to go, maybe we're getting a little bit cautious. So the action we decide we want to take is to sell enough contracts to cover the $3,000 investment. The result of that will be no more risk of loss with upside potential maintained. Makes a lot of sense. So the initial position, $3,000, long 10 of these June 50 calls at 3, we could turn around and, with the stock at 56, those calls are going to be worth somewhere in the neighborhood of $6 plus time premium for 3 weeks. Sell half the calls. Okay, if let's just say they're valued at 6, 5 times, the 6 is going to be $3,000. We'll take in the $3,000 initial investment, less commissions, and we're going to be left with a quote unquote free net long call position of 5. So always a good approach, I think, to lock in profits, take chips off the table, and then let the market see what they're doing. Gives you a chance to have flexibility and adjust those last 5 calls as you get closer to expiration. So that's one approach. Scenario two, rolling out. Stock again has had a good run, going from 50 to 57, about 3 weeks left to expiration. Forecast, the target price remains the same, so we're still looking for 60, but we want more time. I guess the 60 days in all isn't going to get us there, so we decide to buy another 30 days worth of time. So we roll out to a further expiration. Now, a lot of different choices here. In this example, as you'll see, we're going to stay with those $50 calls. So just doing this really for illustrative purposes. And we'll have other examples where we roll up to different strikes. But here, we want to do this, for potentially no cost. So we roll the June 50 calls out to a smaller number of the July 50s, because obviously the July 50s are going to cost, more money than the Junes, whatever that time premium or essentially value of that July 50 put is going to be. That's going to help to define the premium in the July 50 call. So from a capital perspective, we know we've got 3,000 on the line with the stock up at 57. It's closer to $7,000. We've got paper profits in the position for sure. So we decide, whether we want to do the roll for even money to, leave, the current 7,000, on the table, or whether we want to take some chips off the table. Other things to consider: do we want to lower our break-even point? If we do that, chances are we're going to have fewer calls in position, so a little less upside profit potential, but solid position management. So we decide to take the 10 June 50s and roll out to the Julys as stated, but we decide to take a little money off the table because we're going to purchase just 8 of the July 50 calls. They're trading for $0.75 over parity, where the Junes had 20 cents left. So we sell the 10 Junes for $7.20, take in 7,200, and decide to buy 8 of the July 50s at 7 3/4, and take in a handsome $1,000 credit. So the key there, and back when I was on the floor, a lot of the positions used to be, quite large, and you get into some of the front month positions. Oftentimes, I'd manage those things from a dollar perspective rather than, really from a Greek's perspective. It would depend on the scenario. It would depend on, a lot of factors: size of position, how much in each given month, front month versus, other months, obviously strikes. But oftentimes, I would look at that front month position in terms of dollars rather than Greeks. You may do the same, but here's a perfect example where, we started with $3,000. We're getting closer to expiration. We're now up to a $7,200 position. We decided to take some chips off the table, still leave a real healthy position with 8 July 50 calls, but rather than $3,000 invested in the position, we've taken a third off the table, and that's just good position management. So there's our initial break-even point at 53. We rolled down to the 8 July 50s, and we get a little lower break-even. I got a slide at the end that will, explicitly state how we come up with that lower break-even point. But basically, we take the new net investment, all right, so the $2,000, divide that by the number of contracts in the new position. Again, now divide that by the 100, and then add that value to the new strike price, and that's how we get the 52.50. So that's scenario number 2. I hope it makes sense. Number 3, sizing up, rolling up. How about this? We're spot on with our expectation and forecast that the stock's going to go from 50 to 60, and rocking and rolling because we still got 30 days left to expiration. So we were up 20% in 1 month. You can tell this is for illustration purposes only because that doesn't happen often. But, our 10 June 50s are now valued at $10.50. For those of you who may be new in the option space, that $10 is going to be, again, what does the 50 strike represent? The right to buy stock at $50 with the stock at 50. The intrinsic or in the money value of that option is going to be $10. With a month to go, the value of that June 50 put is in the neighborhood of 15 cents. So you add that premium onto the $10 value of the call, and that's how we get our $10.15. So what are we doing here? Our forecast, we're actually more bullish over the next 60 days. So we want to raise our price target and extend the time frame. So how might we go about that? Well, we want to roll up and out to higher strikes. So sounds good. Think in terms also of, wow, okay, we're going to roll up. Am I going to take money off the table? If I'm not, boy, I can buy a lot more options. So let's go through a couple of different examples. Out of the box, we sell 10 of the June 50 calls for that $10.15. So we're taking in a little over 10K. Got 10K, which would mean we got 7K in the bank as a profit, just talking in round numbers. We decide we can buy 15. No, we're not going to take much money off the table because we're more bullish. We just want to buy more time. So we roll up the strike to the 55s from the 50s, and then we roll out a month to July's. And, to invest close to that 10K, we can buy 15 of the July 55s, an option that's considerably in the money, still $5 in the money. We can buy 15 of them. Their price is $6.50. So with the stock 60, you've got the $5 of intrinsic value plus the $1.50 of time premium. That's where the $6.50 comes into play. So we take, a little bit of money off the table, just $400, knowing now our new net investment is the original $3,000 versus minus the 400, leaves us with a $2,600 investment. So there we are. That's with the 55s. If we want even more leverage and gamma to the upside, let's talk through, rolling up to the July 60s. Now with the stock 60, and we had still a month to June expiration, so we would have 2 months, obviously, to the July expiration. To do this for even money, those calls trading at $3.50, we could buy 29 of these things and give us all kinds of upside gamma. All right, our delta is going to be fairly similar, but our gamma is going to be, quite significant. Obviously, the 60s are going to give us the opportunity to buy almost twice as many as the 55 calls. So in our example here, those 60 calls are trading for $3.50. No in the money or intrinsic value with that 60 call, all just time value at $3.50. But clearly, there's a lot of volatility in this stock with it moving 20% in 30 days. So again, net investment remains at $3,000. Original break-even point was the $53. If we roll to the 55 strike, again, we take the new net investment, we divide that by the number of contracts in the new position, divided by 100, and add that to the strike price. They give us our 56.73 strike. Same thing, at the 60 strike. We're going to take that number, add it to the 60 strike, and that's how we get our 61.03 break even. But it's back to the forecast, good discipline of position management, and then you got to decide, okay, do I want to buy an in-the-money call in the 55s? Do I want to buy the at-the-monies and just have nothing but pure theta with my long 29 July 60 calls? That's the decision you have to make, and Frankly, that's a good part of the fun when we talk about trading the options product. So our last call roll scenario is the spread, stock up, target met. We've done a hell of a job forecasting. Still have another 30 days to expiration. And we've got June 50s, these 10 June 50s, trading at 10.20. Now, forecast neutral until expiration. Well, I don't know about you. I do know about me. There's no way in heck, I'm buying 10 calls at $3 and I'm still going to be long them at 10.20. But that's just me. Again, for illustration purposes, we want to go through what really speaks to one of those scenarios about the market being neutral and not doing anything. And that's what this scenario is, where we spread off the long calls by creating a bull call spread. So we can turn around and with the current in the money calls trading at 10.20, we can create a bull call spread where we sell 10 of the June 60s around the long 10.50 calls to get us into a bullish position. Now, we're doing this for a crazy debit. It's a $10 spread with the stock at 60. Let's go to our basics for vertical spreads. A vertical spread, the maximum value can be the difference between the strikes minus the debit you pay. Because we had, such a profit, our initial $50 calls that we bought, we're able to turn around and do this $10 spread, which has a value of probably $8.50 to $9 with a month left at expiration with the stock at 60. We're putting this thing on for a 60-cent debit. But conceptually, what's important is figuring out, what this is, what this position is. So rather than just taking your $7,200 profit, we're trying to enhance that profit by selling additional time premium in the 10 June 60s. That's the whole idea behind this. So that investment, if we turn around and sell these, obviously if we're doing this for a net debit of 60 cents this spread, then we've taken $2,400 off the table with a net investment only of $600. So there's the break-even point. The original break-even of 53. If we put on that full spread for 60 cents, we take the 50 strike, our long strike, add the 60 cents. We've got a $50.60 break-even point. But you can see in green, and let's start with the bottom, as I just mentioned. If we turn around and sold those June 50 calls for the 10.20, we'd have netted a profit of $7,200. A grand slam in my book every day of the week. I'm sure in Don's as well. But if we really believe, okay, boy, the stock's had a run. Who knows? Maybe earnings are after the June expiration. We just think, we really want to try to maximize profits based on this opinion. We turn around and sell 10 of these, June 60s with stock at 60. That's all air. That's all time premium. So the goal is, to take in that additional $2,400. So, that's a different scenario to let that time premium work for you. So that's the call side. I'll run through the puts maybe a little quicker because we're going to, run through 4 different scenarios, same type of scenario, but I thought it might be a good idea just because, especially for folks maybe starting out, the puts can be confusing. So let's give it a shot. We got XYZ at $70. Now we're bearish. Initial forecast, stock going to be down a solid $10 in 3 months. All right, so pretty darn bearish. Again, stock 70, we decide to buy 10 of the at the money May 70 puts for $4. Going back to our call example, each contract corresponds to 100 shares of the underlying. So we take that $4 price, multiply it by 100 for each contract, and then multiply, that $400 times 10. We've got a commitment of $4,000 or a $4,000 debit. And here's the snapshot of our break-even point. I hope that makes sense. You got that long 70 strike. We've got a $4 debit. So you take that 70 strike minus that $4 debit, gives us our break-even. And as the graph illustrates, at 66 at expiration, we'd be break even. If the stock, we don't show this, on the graph there, but what if the stock's at 68 at expiration? Those puts have any value? Well, of course they do. That 70 put represents the right to sell stock at 70. With a stock 68, the value of those puts is going to be $2. So, we'd lose $2,000 if the stock went out at 68 at expiration. You can see, similar to the call example, if our forecast was 100% wrong, stock goes the other way to the upside, we know our maximum loss, and it's a heck of a lot of money, but it would be that $4,000. So I think that's getting back to the whole idea of what's your plan. Hopefully that $4,000 is not too significant a percentage of your investment portfolio. Diversity is always, an important aspect here, but, with our XYZ position, these 10 puts, we know we've got $4,000 on the line. To the downside, below 66 point per point, we're making $1,000, and of course, making a heck of a lot of money if that stock, begins to tank. So that's the initial position. Scenario one, again, house money, but we're talking the downside, not the upside. So let's take a look at that. Stock target not quite met. Again, awful aggressive target, looking for down $10. But in this scenario, we're giving ourselves 3 months, down $8, still 6 weeks to go. Still bearish, but a little bit cautious at this point. So again, let's take those chips off the table. $4,000 worth of chips. So we still have some downside, but we don't have any, additional capital still on the line. So we can turn around and sell, 5 of those puts, those, May 70 puts, with stock trading, down with the stock at that lower level. Take 5 off the table and still have long 5 puts, to the downside if that put continue, or if that stock or index or ETF continues to head south. We've still got 5 long puts. So, that's the idea there. Next scenario, rolling out. Again, target not quite met. We got to feel pretty good. Our puts certainly have made us a profit at this point. With the stock going from 70 to 65, there's $5 of intrinsic value. And then with 3 weeks to expiration and the stock moving, quite a bit, you're going to have some time value. So clearly some profit in those puts. But the forecast, does remain the same, but we're a little nervous about time frame. So, we want to be sure that we give ourselves enough time, don't feel too much pressure. So we decide to roll out to a further expiration. And here we go. We started with, the 10 May 70 puts. We turn around and sell them with the stock 65. We've got, as you can see, $1.20 of time value on top of the $5 intrinsic value. So we take in $6,200, and we decide to take almost $1,000 off the table by turning around and buying just 70 of the June 70 puts at $750. So again, keeping in mind the initial investment was $3,000. We do this roll out to the June 70 puts, take some money off the table, and it leaves us with $3,050 still as our investment, knowing that that initial investment was $4,000 on the put side, a little bit more than the calls. Given the net credit of $950, we've now got a little over $3,000 invested in our downside position. So here we go. Break-even point on the 10 puts at $4 was 66. And given that little calculation that I talked about, the new net investment divided by the number of contracts divided by, that 100 and subtracted from the long strike is going to give us our break even of 65, 64 to the downside at expiration with those long 7 June 70 puts. All right, couple more scenarios. And of course, Don, if there are any questions, however we want to handle it, whatever works for you, but sizing up, rolling up, and, certainly this would be the approach I would take. Certainly, given the forecast where we're more bullish, I'd want that gamma. And if I was more bearish, I'm rolling up to the at the money. All right, that $5 in the money 65 put would let me go through the exact example. But if I was a gamma player, basically not a definitely, a credit spread player inside of gamma positions. Again, when you're down the floor, for the most part, you got Monster, Vega, and more Vega than Delta. At least, that's what I typically trade. And, for the most part, that's the approach that pro traders take as well. They're trading Vega because that's the option space. Delta for sure, but Vega or volatility would trump Delta 9 out of 10 days in my world. So talking about rolling, down, let's see exactly how we want to do that and do a lower strike. So the initial position where the stock 70 was 10 of those May 70 puts at 4. You roll down, we get to sell 10 of them at $10.50 and turn around and buy 14 of the 65 puts, and we're buying them for $7.50. So, clearly they've got some intrinsic value. We've got some additional gamma. So we're, going from long 10 puts to 14. So we buy some gamma, but we're doing this for even money. So we've still got that net investment of $4,000 on the board. Good approach for sure. Again, personally, I'm rolling down to that at the money 60 put to give me additional gamma, but rolling down to the 65 put makes plenty of sense, plenty of good sense as well. And here we are. If we take the new investment number, which is that $4,000 divided by the new number of contracts, divided by the new position, and by 100 minus the net minus from the long strike now at 65. That's how we get our new 62.15 break even. And then if we roll down, we could do that to the 60 puts, what I keep talking about. We get to do, we'd be able to buy them for by 21 of them. And let me just back up a little bit to see if that number actually comes up. There we are. Okay. There's the 60 puts. Sorry, I jumped over that. So again, selling the 10 May 70 puts, taking in the 10.5, and the original investment again was $4,000 on the put side. Those June 60 puts with the stock at 60 are trading for $4.50. So a lot of juice, but we're rolling out in time. We believe in the downside, so I like that gamma, and that's what we're buying here. Obviously, more so than the 65 puts. In our example, at $4.50, if we buy 21, we take $1,000 off the table. So we're reducing our net commitment by 25% to just over $2,900. Again, the break even for the 65 strike, and there's the break even for the 21 June 60 puts. Again, after you figure out the calculation on the put side, you got to subtract it from your new long strike, which is how we get to the 58.60 price. So one more time, spreading off, just as we did at the calls, trying to maximize that time premium. Let that work for you, because our forecast has changed. We're not more bearish, we're neutral. So rather than just take our $6,000 plus off the table. We want to enhance that. Targets met. Stock's going from 70 to 60. Still got a month to go, which is why we can turn around and sell the at the money strike, which is going to be that 60 strike. So again, about $6,000 profit with the puts trading at least $10 with the stock at 60. We could turn around and create this bear put spread. Long the 70 put, short the 60 put. In our example, we bought the 1070 puts for $4. The stock at the time, I think was 70. Turn around and sell the 10 May 60 puts for $2. So certainly more of a debit than we had on the call side. We've got a $2 debit, which means, we're taking half the chips off the table. Rather than a $4,000 commitment, it's now $2,000. And here we go. Break-even point lifts from 66 to 68. And as you can see in green at the bottom, maximum profit could now be $8,000 as opposed to taking our $6,000 profit off the table with the stock at 60 and the puts trading for 10. Well, why an $8,000 profit, you may ask? Back to those vertical spreads. We put on a bear put spread, long the 70 put, short the 60 put. Difference between the strikes, $10. What do we pay for that put spread? We paid a $2 debit. So what's the maximum profit of that put spread? Maximum profit is going to be the difference between the strikes, $10, minus the debit we paid $2. There we go. $8 maximum profit. And in order for that to be the case, stock would have to be 60 or below at expiration. So there are 4 examples in calls, 4 examples in puts. I hope they made sense to you. Again, I went through, how to calculate the P&L and those new break-even points. As I mentioned, you take your net investment amount after the roll, divide by the amount of number of new contracts in the position, divide by 100, and then add that or subtract it, to the new strike. And that's how we go about calculating our P&L and our new break-even points. Of course, when we're talking about rolling, I would always err to more time. The other thing, that's easier said than done because more time costs more money. And again, depending on maybe when earnings come out, unexpected corporate announcements, you can't count on that, but certainly that earnings cycle every 3 months, easy to say I want to roll out, but different months have different implied vols. So just, be aware of that. And most importantly, have a plan and do your best to stick to it. And in terms of the whole post-trade monitoring, after you put on a position, it's not to say you're going to sit by your computer all day. Maybe some of you are day traders and, that's great. But I think more typically, the retail investor puts on a position, believes in it, maybe checks it every day, maybe a couple times a day. But most importantly, if he or she doesn't, it's really not that important because hopefully you put on a position with a limited risk, all right? Or at a minimum, you're going to have TradeStation send you alerts if your underlyings, move to certain different levels. So just figure out how you like to track your positions and then have fun, making money or managing those difficult positions. Don, I'll turn it over to you. Just want to quick, not commercial, but some of the resources that OIC has. Our website, easeoptionseducation.org, all kinds of implied volatility charts, podcasts, webinars on the YouTube channel, all kinds of things like that. So that's where you can find us. And I would encourage you, we have our investor services group, just like, the support group at TradeStation. You can reach our investor services group, and it's Bill, Ed, and Mark. 5 days a week, you can reach them at options@theocc.com. So With that, Don, I'll turn it back to you.
Thanks, everybody, for helping us out today and coming on to this TradeStation webcast. Every day we handle a number of different types of webcasts as we preview the markets, we offer notes from our homework, we gather information from traders, we look at our technicals, and then we hear from trading analysis from notable professional traders like Joe Burgoyne at the OCC. We are going to close this out on a high note. We know it was a great presentation. Joe's one of the top educators in our field. We know that you want to have an amazing trading experience, and discover and craft various strategies and then test those strategies, and of course make adjustments as needed, which is why we brought Joe in to talk to us about how to roll your positions. We'll be back again tomorrow for the TradeStation morning market briefing, 1/2 hour before the market opens, to help you get your edge on in the morning ahead of the market.